Let's take a look at another ratio, a common ratio. You'll hear this one all the time. It's called the current ratio. It's called the current ratio for a very clever reason. It takes our current assets and divides those by our current liabilities. What this is getting at is a measure of liquidity. In other words, how quickly are we going to turn our current assets into cash so that we can then pay our current liabilities? Again, it's not a perfect measure of liquidity, but it's an approximation. Using our data again, we're going to calculate the current ratio for our example company. We find out, okay, it's 0.83. What does that mean? It means that for this company in X8, they had 83 cents in current assets for every dollar of current liabilities. In X9, that had gone up to 0.89 or 89 cents for every dollar of current liabilities. Now, historically, current ratios have been higher. 30 years ago, a current ratio of 2 to 1 was kind of a benchmark. But now, as we've become more efficient at managing our current assets and current liabilities, we've been able to drop our current asset levels down relative to our levels of current liabilities down to the point where, in many cases, for many companies in quite a few industries, a current ratio of less than 1 to 1 is quite common and nothing to be alarmed about. In this case, 0.83, it went up to 0.89. The big question now, what's our competitor? Our competitor is 0.79. So again, in this industry, having a current ratio of less than 1 to 1 is quite common. And now we're down to the question. Why? Why is our competitor at 0.79? Why are we at 0.89? Who's got the better current ratio? And that requires us to drill down deeper and deeper, get to know more about the company and the composition of its current assets and its current liabilities. But this tells us, okay, we're not that far off from our competitors. We're both less than 1 to 1. So we don't need to panic about having a 0.89 current ratio. Turns out in this industry, less than 1 to 1 is quite common. Current ratio is giving us a measure of our current assets relative to our current liabilities. It's a measure of liquidity. Our next ratio, return on sales. What that's basically telling us is how much profit do we earn for every dollar that we generate in revenue or in sales. And it's calculated pretty straightforward. We take our net income, divide it by our sales, and get a percentage. And again, what this is telling us is for every sales dollar, how much of that eventually, after we take out all our expenses, how much of that drops to the bottom line and is reported as net income. Again, using our data for example company and the competitor, what we find is in X8, 3.9 cents of every dollar of sales dropped to the bottom in terms of profit. In X9, that had increased to 4.2. So that's a good trend right there. It's going up. Up is always better than down when it comes to return on sales. And now we have the question, what's our competitor doing? Our competitor's at 2.9%. So while we're coming in for every dollar of sales, we report 4.2 cents of profit. Our competitor wishes they were us. They're only reporting 2.9% of profit for every sales dollar. So if you're the competitor, you're saying, what's the example company doing that we can learn from? How can we make our profit margin or return on sales go up? Again, it's a quick calculation, easy to do, tells us a lot about how a company's performing in terms of profitability.